between institutional order flow and interbank order flow. What are the difference? What are the differences between the two, rather? If we have an idea that the market is wanting to be bullish, okay, in other words, it's a bullish buy model, okay, or in a buy program, what we're looking for are up close candles to be broken because they would otherwise be bearish order blocks, and we want to see down close candles find support. So let's zoom in here and I'll give you some ideas about what that means. So we have a smart money reversal here, and then from that point on we want to see up close candles over here, up close candles being smashed through. Okay, market comes down, trades into a bullish BISI, buy side imbalance, sell side inefficiency, fair value gap. Price starts to go higher. Every down close candle, when we trade back into it, it supports price and sends it higher. This is the largest down close candle from this move here. The market trades back down into it. Does it go higher? Yes. Market comes back down again, trades inside the order block, it leaves it. Now we have these two down close candles. Take that range out in time. Does it rally from there? Yes, it rallies. We have the last down close candle here. That's the bigger bodied candle between that one and this one. When price trades back down to that area, does it? Well, it doesn't really quite get to it, does it? It gets the high 97.08, the low 97.52. Okay, so what is that? Okay, so the high on this comes in at 97.08. Okay, so 109.70, and then the low on this comes in at 109.71. So it was only off by 1 pip, but we rally. Fair value gap is closed in here. We rally up, down close candles. We trade above it. Is it supporting price? Yes. We have displacement, down close candles in here. The high 109.84. Market comes back down into the low 109.84. So is the price being supported there? Yes, we rally. So what is institutional order flow? Bullish. Down close candle, is it finding support? Yes. Down close candle, is it finding support? Yes, rallies. Down close candle, is it finding support? Yes. Down close candle, is it finding support? Yes. Does it rally? Yes. So as we're looking for price to go higher, we're looking for down close candles to act as support levels. Okay, not just an entire range, but we're going to calibrate everyone we come into contact with in regards to a down close candle. For potential bullish order blocks, we're looking at the high and the open, and in the mean threshold of the body. Those are the 3 levels. Now those 3 levels are further calibrated to the nearest 5 level and 0 level. So the nearest one you would trade to, that's the one you look at for buying or looking for support to be provided for price action. Now the difference between institutional order flow and interbank order flow, we have to zoom back out a little bit. Okay. Interbank order flow is where we have the imbalances here. We have a buy side imbalance, sell side inefficiency. So all of this creates a gap. The market wants to come back down into that area, and that's where interbank will have their orders collected. Institutions, and yes, some measure of interbank is inside of institutional order flow, but largely it's institutions pairing up with the central bank to provide the order flow that you see on your chart. Interbank order flow is going to be where there are gaps. Okay, and what do I mean by that? And all of this area in here, where there's SIBI, sell side imbalance, buy side inefficiency, all of this area here is going to be layered interbank order flow. So all of this area here where it was all imbalanced to the downside. Too much sell side, not enough buy side. In other words, it only went down, not enough up movement in here. Look inside this shaded area, how much time they spend working in that range. You see that? All of this is where interbank is going to be working a lot of future price delivery. And you see it happening here. In this area in here, right there, we have again another section of SIBI, sell side imbalance, buy side inefficiency. In other words, only one single candle passed between this candle's low and this candle's high. So all of this is imbalanced to the downside. The market will want to efficiently trade to the upside. The market trades up, passes back down to this level here. Let me see, I do the low at 110.03, right into here. So you can see we're working inside that range as well. And we come back down into it again here. We touch it here. We touch it here. These levels are not random. Okay, it's not just static noise. It's reacting to this range that's over here. So IPTA remembers, because of this imbalance, it understands that this area here, it wants to return back to multiple times. So you don't see this as a demand zone, okay, in supply and demand. You wouldn't see this as an area to buy because it's just simply an imbalance. They're looking for areas where there's consolidation, rally, and then that creates an opportunity to go back inside that consolidation and find, a zone. This is an imbalance. The interbank order flow will occur inside that area and respect these specific imbalance parameters. The boundaries that create the high and the low of the imbalance, or in this case the SIBI, they are what is referred to as natural support and resistance. Okay, now natural support and resistance is not the same thing as taking your levels and drawing on old highs, old lows, and expecting the market to return back to those levels and stop dead in its tracks and go the other direction. I mean, think about how many times, like this low here, did it go down to that low and stop and turn around? No. It went right through it. Well, we have a high here, and it did a pretty good job of hitting it there and then trading lower. Yes, it happened to happen there. But what about this low? Did it find support there and rally? No. What about this low? Did it stop price when it went back down to it again? No, it went lower. What about this low here when it traded down to it here? Did it stop? No, it went lower. So that's the other side of the equation. When we have imbalances like this and what we shaded up in here, that's going to be internal range liquidity. And you'll learn about that also in the core content. Interbank order flow exists outside of the chart. That means below old lows, you're going to have sell side liquidity. That's why when you're watching my annotations on my chart, you'll see below old lows or specific levels, I'll have sell side liquidity annotated. And above areas like this, I would have buy side liquidity annotated. What I'm teaching you is where the interbank order flow is, because it's outside of your chart. The chart only shows a candle low to a candle high, and everyone's worried about patterns and levels that create the high and the low. I'm interested in specific price levels above these old highs and below these old lows in the form or range of 10, 20, and 30 pips on a sweep, or 5, 15, and 25 in terms of grades of above and below old highs and lows. Because IPTA will search for liquidity in that manner. So the next question you're going to have is, well, which one do I use, Michael? Do I use a 10, 20, and 30 pip sweep for highs and lows? Or do I use a 5, 15, and 25? It depends on what your ranges are working on. In other words, from this low to this high, is it a 10 level? Like, is it a 10, 20, and 30 or close to that? Then you'll probably have that much of a range above. Work on the 10, 20, and 30 pip sweeps. But if it works out to be like a 15 pip or a 25 pip range between low to high in that dealing range, then you would look for your 5, 15, and 25 pip, respectively, above the high, looking for liquidity. So what you're looking for is a combination of both of them. Okay, when we're in a trending move, institutional order flow is my go-to. But I'm also referring to where interbank order flow rests just above if I'm bullish or just below when I'm bearish, because that is going to be the primary draw on liquidity. Ooh, so there's the difference. Order flow is the momentum and how you gauge whether or not, if the delivery of price is being efficient and is it being absorbed from an institutional level. So as price is going up, that's the central bank offering higher prices. But if the institutions are not buying on down closed candles, if that starts to not be evident in price action, then what you're seeing is there's a measure of distribution about to take place, and the market's going to go the other direction or go lower in that instance. And then you would seek an area of interbank order flow where there would be an imbalance, or trade below an old low for the sell side liquidity. Everything I just said reverse when we're bearish. Where we're at right now, we do have a small little imbalance in here. I don't think it needs to go down to there, but if it does go lower, I'd like to see it find support there and then make an attempt to clear these equal highs. That's what I think is going to happen between now and non-farm payroll. What we do after that, it remains to be seen. I don't like to forecast too much with non-farm payroll.
Times and you're not on board with this. I want to look at something else. Well, that's the reason why you're not doing well. Think about it. If you look at this and you practice it every single day, you're going to get good. There's no doubt about it. It's a default. It's going to happen because the market, 90% of you all know that if we are slightly bullish and there's an equal high to the left of us, you know where it's going to go. Now, the problem is you all want to know if it's going to go up there and then sell short. Why do you need to do that? If we have a range between here and this high here, this is just a single point pull of liquidity. A double high or double top, that's just another form of a liquidity pool. It's just two of them. But a single stop point right in here is enough for me. It's still a low resistance liquidity run. But even in the free membership area on Twitter and on my YouTube, everyone knows how to use the equal highs and equal lows as they run on liquidity. It's simple. But it's not limited to that. You can use a single high, previous day's highs and lows. Remember, that's where the large institutions are going to have their liquidity at. So, that's just one example in here. Here's another one. We have this little run up in here. So this candle's high to this candle's low. There is a inefficiency in there. Split it in half. As price hits it, you buy it right there. Boom. So you can actually see a little bit of a run in here. The market opens on this candle and drops down into the order block. Right there. That's that order block I mapped out as it happened in real time. And all it did was drop down into an order block, and I said, okay, now it's going to run up and blow out the Friday high, and then it did it. Okay, so we watched it actually on a 5-minute chart. So in fairness, you can see it. Right in here. Hits the order block right there. And then runs through. I'm out of it here. It gets stopped out here. And then the secondary run up where it's all just really being driven by the central bank. They're really pricing it higher ahead of the Brexit vote. Now, does this mean it's going to keep going higher tomorrow? I don't know. And I have a lot of members that live in the UK. They're asking me what my opinion is. I'm learning all about Brexit, just like you are. It's a new thing for me. It's a fundamental driver that is completely unique. There's nothing else like it. So I don't know. I'm going to be honest. I have to tell you, I don't know. I want to see what is going to happen just as much as you do. So a lot of movement today. You know how to practice now. Real quick so you guys can see it one more time. There's the two positions. And that little tiny little drop down here. There's the entry, and it has to be a little bit lower to get that fill because of the spread. So I'm right in there at the middle. That's what I hit it at. As it went through the middle of that, I hit it. Very, very, very little drawdown. I mean, that's beautiful. I bought the down close candle that made the low, that swing, and I sold it above the known liquidity pool. Now, again, this is all being shared on free member level. So people outside the mentorship, they're watching me do this. And that's fine. This is not what you got tonight. They have no idea really what drove all this. Some of them might see some things, but they don't know what I just told you. And in fact, they don't know that the 15-minute time frame here, this is a market maker buy model. Consolidation, we left the consolidation, retrace, okay, that's a distribution, redistribution, another level of redistribution, smart money reversal, low risk buy, reaccumulation, boom, cleared it out. So there's your market maker buy model. Okay, nobody's talking about that on pre-membership level. Nobody's talking about it on Twitter either. But there you go. So, again, that was another reason why I was comfortable buying over here, because I knew we were over here off of an area where we did some distribution. So it's going to reverse its roll over here and accumulate to the upside. And then there you go. So hopefully you found this insightful. Now you got some kind of a structure with practicing a little bit different.
Welcome back. So I'm going to talk a little bit about the seek and destroy market profile. And if this is a new topic for some of you, just know that when the market's uncertain, or our analysis is likely to suggest that the market is consolidating or sloppy or kind of like summer trading, and specifically around the non-farm payroll week. Just so happens that this is where we're at. The market can tend to go sideways and take out both highs and lows, run to a significant level, and then reverse hard and go in opposing direction. Today we had that very thing unfold. So I want you to take a look at this line chart here and notice how all the swing highs and swing lows get taken out. Then there's a run up and then crashes. And we're going to go behind all of this idea and flesh out how the algorithm does similar to this. Now, you've recently watched me do trading the seek and destroy profile. So now I'm going to show you with another example here that the market will seek specific levels of liquidity and how we can anticipate that and study it and learn how to, majority of the time, avoid it. All right, so we're looking at the euro dollar. This is an hourly chart. And as a reminder real quick, this is the only thing we're going to be touching on today because the markets are sloppy. And tomorrow, which is Thursday, there will be some heavy news for GBP. So check your economic calendar on forexfactory.com. Look up GBP for tomorrow and you'll see the heavy news that's coming out for it. So euro dollar hourly chart. You can see how we've had a buy side liquidity pool swept and then a sell side liquidity pool attacked. So with these levels in mind, we're going to drop down to a lower time frame chart. All right, so here's the 15-minute time frame. Here is midnight New York time on the 4th of August, 2021. And we had a shallow consolidation, creating a short-term initial high of the day, right around the 3 o'clock in the morning hour, New York local time. Then repricing lower for the London session, creating the initial low of the day. But notice what it did. It swept the sell side liquidity first. Then rallied up through New York open, attacked the initial high of the day, buy side liquidity pool, then repriced to the buy side liquidity pool shown on that hourly chart. Then crashed all the way back down to take out the sell side liquidity pool, resting below the initial low of the day formed in London, and then consolidated going into the close. I'm going to drop down into a 5-minute chart here and flesh this out for you. We have 7 p.m. New York time, midnight New York time.
On a 5-minute chart, you're going to look for the highest and lowest prices. And you'll also do this with the highest open or close or the lowest open or close price. So you're going to get two measurements. I'm going to save us a lot of time, but you do this on your own study. Do it on the bodies as well. I'm showing you on the highest of the wicks on both swing low and swing high. Now it's important that you do this on a 5-minute chart because the algorithm will do this on this time frame. Okay? It does not work on a 15-minute chart. It does not work on a 12-minute chart, a 3-minute chart, a 1-minute chart, an hourly chart. This will only work on a 5-minute chart. So it's calibrated to this time frame. The highest of the Asian range, which is the range between 7 p.m. and midnight, New York local time. This is the Asian range high, the Asian range low. Once you have this range, you can do a lot of studies with it and project them up and project them down in the form of standard deviation. The consolidation that starts after midnight sweeps initially the Asian range high, right there. Breaks, and one more time sweeps above it, sells off. So you're having a very small 5-minute optimal trade entry sweeping the Asian range high. So what you would do is draw that out in time, and you see how they've worked it here, here, and then it reprices lower to attack that sell side liquidity pool on the hourly chart. That's that red line. It plunged below that, creating the initial low of the day. Rallied off of that through London lunch. It was quiet, and then right on schedule, 7 a.m. New York open kill zone. It reprices higher, sweeps down into a fair value gap, reprices on the ADP non-farm change that came out at 8:15 a.m. Eastern Standard Time. So you're having an economic driver drive price higher, and it attacks the initial high of the day formed in London. That buy side liquidity pool has been taken out, retraces, institutional order flow entry drill, rallies, and then sweeps the buy side liquidity pool here. If you look at the high of the day, go up 20 pips, it falls 1 pipette short from a perfect 20 pip sweep above the initial high of the day. Now every brokerage firm is going to have a slightly different high here. Some might be a little bit higher, some might be a little bit lower, some may be right on 20 pips. That's always the degree of separation between what's likely to be seen in our charts at retail level and that of what the interbank actually prices at. So about 5 pips variance is normal. You're going to find that what I teach you, the Asian range standard deviations, and how to measure them out, you're going to get within 3 pips. That's usually the standard. So it's like a variance of 3 pips from what the actual high of the day is and what these levels will call. You might be a little bit over, a little bit under, and sometimes right at it. But 3 pips is as close as I can get you without doing things I'm not supposed to be doing. So if you look at the high here, this is the high of the day forming ahead of the ISM services PMI number for the dollar. So this was dollar-based, and this was dollar-based, both high-impact news events. So on this candle right here, that's the 10 o'clock candle, we swept the buy stops first, then came off a little bit, and then the algorithm aggressively reprices, attacking the sell side liquidity resting below the initial low of the day. Now, I want you to think about it from a narrative standpoint. The market rallies up ahead of the high impact news, the last high impact news for the dollar at 10 a.m. So it runs the stops first, knocking out anyone that was short overnight with London, really sweeping it up higher, taking out that hourly swing high, failing to get to the 119 big figure. Now, again, your live account might show it touching the 119 big figure, but that's not my argument here. It's the purge of the liquidity above this level on the hourly chart ahead of the ISM PMI number. The initial number here came out that was poor for dollar, sent price up. It swept the buy stops. Then they released data that was strong for dollar, and then you have this displacement on the downside attacking the sell side liquidity. So if we take this and go one step further, here is the standard deviations here. What I'm doing here is I'm using the Fibonacci trend tool, anchoring to the low, up to the high, back down in. You'll get this projected level here, 2.5. So this measurement comes to 1.18978. So look, we can put that level here and take the other level off. So we have this level and the old 60-minute or hourly high. You can see we swept above that here. But now I'm going to take you into swing trading ideas and how we can use that information. The swing low at A up to the high of the day at swing high B. These two reference points are the initial high and low of the day. When it breaks this high and it's rallying, how far can it go? Let's say you weren't paying attention to that hourly chart and you didn't notice that liquidity pool. It happens. I mean, you're developing. But you do have the standard deviation 2.5 level calling for this right here based on the Asian range. Let's see if we can get some confluence in agreement within 3 pips from this low to this high, and we'll just use the regular Fibonacci. So we're measuring the low up to the high, and make sure you're toggling on your settings negative 0.5. It's calling for 118.98 and 8. Okay, so that's what we're looking for on the Fibonacci. We're not using Fibonacci on the basis of the classic extension levels. I'm not teaching that because the algorithm doesn't care about that. You see so many people out there looking for the 0.88 level and all these other levels. That has nothing to do with what the algorithm's doing. All we're doing is looking for this range here to here and deviations above and below that are in increments of half of the range. This is 1, 2, 3 of 1/2 of this range. Okay, so 1/2 of this dealing range, high to low. This is 1, 2, 3. This is almost in agreement with this level here. So if we have that, we know that there's a likelihood that anywhere in here up to the big figure, 119 big figure, we could see it reach up for that. But now couple that with the initial daily high, 20 pips higher, lots of confluence in here. So look what's going on here. 118.97 and 8. 1 pip above that would be 118.98 and 8 pipettes. 2 pips above it would be 118.99 and 8 pipettes. And then we would go into, obviously, the 119 big figure. So within 3 pips, like I teach in the mentorship, you're going to learn about this, obviously, if you're in the 2021 group, when you get into model number 5 as a charter member. And you'll hear me talk about how in the teachings for the standard deviations on the flout, Asian range, and central bank dealers range, it gets within 3 pips of the daily high and low. But you have to have other things in agreement with it. You just can't say, well, I'm going to look at, a standard deviation of 2 or 3, and then that's enough for me. that's not how it works. You have to have some other things that lend to that idea, like we have here, 20 pips reaching up above the initial high of the day, going into a high impact news event. So it's running up, and you've seen me talk about this before in other teachings, where a liquidity pool that is being purged ahead of a high impact news event usually is them pricing in an extreme premium for them to run stops out and then aggressively go the other way. And that's what we're saying here. Now for the low of the day, we have the initial low of the day here, and you can see that price is 118.42 on 1 pipette. Now I want to talk to you a little bit about calibration. Now calibration is where you take what you receive in your retail feed, which is forex.com here. If this low comes in at 118.42 and 1 pip add, is it really 118.42? No. It's really 118.43 because it did not come down a full pip to get to 118.42. It failed to do that. So the round up to the nearest pip would be what? 118.43. That's what you have here, noted. 10 pips down below that price takes us here at 118.33 even. And it goes just below by a hair, and that's a 10 pip sweep there. So you're looking at how the market trades with these aggressive runs using the news. When it's in range trading, it's in summer doldrums, it's ahead of a big news event that's going to occur for GBP tomorrow. And then we have non-farm payroll as well. So there's lots of landmines, and that's what I mentioned ahead of time. Try to be very careful trading this week, because if you maybe got caught by this, maybe got hurt, and you don't want to tell me, this is seek and destroy. It's taking the liquidity on both sides of the marketplace, running up for one that's going to really pay out later on, which is the buy side liquidity here above that 60-minute chart high, and then attacked all of the individuals that went long here. So look what they did. They punished the shorts from London that made money here. They ran those out. Really ran out those individuals that were short back further, took their stops out before the nice crash here, attacking the individuals that went long. They weren't allowed to be profitable either. So when you look at this and understand that that 5-minute chart here is the same thing here, exactly what I teach. This is actually a teaching that I did, showed publicly on baby pips. But the original concept still holds true. But the thing that sets it up, which is the reason why I tell you the non-farm payroll protocol, we try to trade Monday up to Wednesday's New York Open. London closed on Wednesday of non-farm payroll week. We do not take any more trades because this is classic. You will typically see a non-farm payroll week give you a seek and destroy type event. FOMC week typically will have this type of event as well. So those weeks, there's the reason why I tell you to be very, very careful, because if you don't know what you're doing, you can very easily get caught up on the wrong side. And even if you're on the right side, it can come back and bite you. That's what seek and destroy. It's seeking liquidity to destroy both sides of the marketplace. So since it's sweeping both sides, one of two things can happen. Tomorrow, it could be a lackluster day and it does nothing, and no one's positioned to do anything. Or they clean both sides, and then I'm going to make an initial run tomorrow that will be really nice, that gets attacked for non-farm payroll Friday. So hopefully you got something out of this, and I'm stimulating your thought process and justifying why I tell you to stay out of the marketplace post New York Open on Wednesday on non-farm payroll weeks. Now, it happens to be delivered on a Wednesday this time, but it's because we're ahead of big news tomorrow, and we're in August, and it's non-farm payroll. So it's a tricky week. It's classic seek and destroy conditions, and now you know a little bit more about it. Until I talk to you tomorrow, be safe. Again, same here. Opening on this candle, extend it out in time. When it trades down below that after midnight, so it's after midnight, that's the time element, time and price. What's the price? It has to be at or below that level. So here is the New York Open, and this is also an optimal trade entry here. Low to high, drops back down in, below the opening price. There you go. For some of you, this is all that's required for a model. You know your framework, bearish dollar, higher euro. Find your opening price at midnight. Buy it at or just below the opening price. And just hold it. Hold it until we get to the afternoon in New York time and unload it
above some old high. That in itself, that is a complete model. I'll say it again. If your framework is bearish dollar, that means you're bullish on euro. Mark out the opening price at midnight on an hourly chart. At that price or below it, in a kill zone, you want to be buying it. Then get out in the afternoon. That means anywhere between 11 o'clock in the morning to 1 o'clock in the afternoon, New York local time. And if you can be there above an old high, you have time and price meeting. So there's your exit strategy. How much money should you risk? 0.5%, 1%, nothing more. How many trading days did you have that were favorable with that? With that framework I've given you, with bearish dollar, higher prices in euro and cable, you can buy here near the low of the day. You can buy here near the low of the day. You can buy here near the low of the day. It doesn't need to be complicated, but you signed up for all the freaky insights, all the things that nobody else would ever learn. That's why you're here. That's what I'm teaching you. I'm also teaching you how to trust almost 30 years of experience in knowing what the market's likely to do next. Don't arm wrestle me. Just try to get yourself in alignment with what I'm teaching you and direction, what I'm looking for and pointing to. They aren't changing day to day. The daily bias isn't daily bullish, daily bearish. Daily bullish, daily bullish, daily bearish. It's not that. Some of you think that's what this is. When I'm saying I'm bullish euro, I'm bearish dollar, and it's going to stay that way for a couple days, if not a week or more. So remember, the hallmark to this mentorship is we're trying to trade inside of the weekly range, and we're forecasting. I'm teaching you how to forecast the expansion of the weekly range. In other words, the candle that makes up the weekly chart
pans out, that takes us up into this level. This is only a 50-minute chart. If we drop down into a 5-minute chart, more setup. Fair value gap in here from this candle's high to this candle's open, very small one, trades down into it, rebalance to a bullish order block, expands on the upside. We have a fair value gap here, trades down to it. Does it go beyond it? Yes. Where's it trade into? The bullish order block. Where's your stop going to be? It needs to be below a swing low. It wouldn't be anywhere near here. It wouldn't got stopped out. We have nothing else in here. Yeah, nothing else in here. And after that, expands on the upside. So how could you use this information in the setup for TGIF? If you're looking at like fair value gaps down here, okay, we trade below this low here, which is all that's necessary, trading to that low. We get it here and here. You could have got that fill in the upside. We can take a fib. Here's our, if this is the setup we're going to be using, fair value gap. If we trade to that price point up to the 30 level, I'll do the 20 level in a second, but here's our unrealized dealing range, equilibrium. So your setup has to form between this low and the equilibrium price point. Okay, if we see a signal up here, it's lower probability. It can be there, but it's less likely to pan out. Your fair value gap, your bullish order block, your optimal trade entry, okay, those will be better from this price point and under to here. And every setup I just gave you was in that discount market. From this level down to your projected entry, this is a discount. This is where it's high probability for it to expand up. If we drop it down to the 20 level, which is here, it's really obviously equilibrium's here. It's still, we can get the fair value gap here. We can get the fair value gap here. And that's it. We missed a boat on everything else. Nothing else in here. But it allows you opportunity to expand and get range. Now, I probably went really fast with all that stuff, but trust me, we'll see a lot more of that. I introduced the unrealized dealing range last week, and I know a couple people have already emailed me. I don't understand the unrealized dealing range. You won't. I only talked about it just last week. Okay, think about how much time we've talked about fair value gaps. That's why you're here, to learn. Let me teach you, but it's going to be on my pace, not yours. I'm not going to cut corners for people. Everything is delivered the same way. Through the lessons, when it's applicable with real examples, you can see it. It's not contrived. It's not the bones about what it is. And I'll show you with many examples and more insights as we go. Just trust the process.
17th for illustrative purposes. And let me bring this back up because
Listen, there you go. All right, so I gave a lot of details on the YouTube example. Okay, the things that were missing are what was shared to you all on Friday's weekend edition of the ICT Mentorship Commentary. We were looking for higher prices on Euro. We were looking at it in the form of a high resistance liquidity run. And you can see a lot of that give and take in here. But still, even though it's framed under the idea and umbrella, if you will, of a high resistance liquidity run, the signatures still manifest. And they're very strongly linked to time and price. When price went below the relative equal lows here and ran through that, all of this movement here is a Judas swing. When price broke higher and went back down into the previous day's low, which is the 16th, we hit the order block here, and as it's trading lower, right into here, this is where you would have been buying down as it's creating this run. When this candle was bold and down close in nature, that's where you'd be buying. Buying it over here in close proximity to the order block is still fine, as you saw. I had my stop loss well below this low here. It was a 15 pip stop loss, and you can also see the leverage I was using was minuscule because it's not necessary to have a high level of leverage and over risking. The idea that the market would create this buying opportunity is linked to the bullishness that we outlined on last weekend's weekly commentary. The relative equal highs, that was not your final terminus. We were looking for the market to reach up into those 119s, okay, and trade above its old highs that it formed on the daily chart. Inside this breaker, a breaker is an order block. 50% of that order block is the mean threshold. If you take that and extend it out in time, that's what the bodies are respecting here. So there's an overlap of the bullish candle here that caps this run down. It clears the sell side liquidity pool here. Mean threshold, extending it out in time, that's what these bodies are respecting. So the bullish breaker here, when it trades above it, comes back down in. We have optimal trade entry. We're below 50% of the low to high of this interbank dealing range. So we are in a discount. We trade to optimal trade entry. We trade into the mean threshold of this big down close candle. So we have a mean threshold there. We have the mean threshold of the bullish breaker overlapping with the New York session and with a bullish bias. What was the bias outlined on the weekend edition last Friday? We were looking for higher prices in euro, higher prices on cable, and lower prices on the dollar index. Now, when it left these relative equal highs in here, that is enough. You saw me execute on that, and it's been in the YouTube channel. But on the 18th, yesterday, you can see how price was aggressive in here, but on both sides. We cleared sell side liquidity, then we cleared buy side liquidity, and then we came back down into it deeper here, and then expanded, cleared the highs, came back in. Right in here we have New York session. So we have what? This price swing, then we retrace back down in. All of this price action here, right in here, is keying off of a breaker. What it's trading down into is a breaker. See this low? It's higher than this low. And I'll show it to you like this. Low, lower low. So what's the high in between these two price points? Right here. So this That is your breaker. Okay. Notice the bodies of the candles. That's the mean threshold. Let me zoom in a little bit. So this candle's body is what I'm measuring. That's your high and your low. Split that in half. Extend that out in time. That's what the bodies of these candles are respecting. Yes, we get these little tails, but that's fine. I've already taught you that that is permissible. You have to endure that because that's where the broker's nasty business comes in. It's not likely you see any of these tails coming all the way down below here. If you do, you have a real problem with your broker, and it's probably time to change. But we have this price run here, and then we trade right back into the mean threshold of this last up close candle, clearing these lows. So the high in the between is this last up close candle, and should we trade above it, which we do, if we come back down into it, that is a bullish breaker. Couple that with okay, you see that? 50 level is 19 and 7 pipettes. That's here. And we're trading below it here. So we're at a discount on all this time period inside of a bullish breaker. The bodies of the candles respecting it. So the IPTA is absolutely in control of price here. And then finally in New York session, yesterday, price expands and blows up through, creating the high in here on this candle at 950. At 950, price retraces, comes all the way down into this buy side imbalance, sell side inefficiency. Then we enter into that consolidation phase between the premium end of the fair value gap and the rejection block on the daily chart for euro. And then we finally collapse. So this price run in here is all breaker based. Okay. And that is the last bit of business for this commentary, and we will discuss more on Friday when the week's trading closes. Until I talk to you then, have a pleasant week. Rest. Try to take advantage. On the smaller time frames, 5-minute chart, you can see the midnight delineation here, New York time. And the market trade down initially first, and then rallied all the way up past, notice this, past the London kill zone. We're trading almost into 6 a.m. and then we have the break. Comes back up into bearish order block. Breaks again, small little imbalance. And then here, the optimal trade entry is where the change in the state of delivery is the last up close candle, that opening price, down to the low. And you see the optimal trade entry 62, 79 respectively, and then 70.5, which is not noted because I'm showing you the breaker. The high of the breaker and the low of the breaker. That's what's being shown here. And look at the beautiful delivery to that price point there, that particular candle. We are not supply and demand. Supply and demand does not come this close. It doesn't even get in the same vicinity, not even in the same zip code. This is pure perfection. So when you have the market trade back up into that level and you're into optimal trade entry and you had a market structure shift here like it does there, and we're now in New York open kill zone, this is a breaker. Sell, optimal trade entry, runs the sell side liquidity here and that bullish order block on the daily chart. That's that level here again. It trades down into it, digs into it one more time, trades back up, fair value gap there. Another sell-off, attacking the rejection block, but leaves relatively equal lows. To look at just this little portion of price action, and then eventually expecting it to trade down here at a deferred time in the future. If the market has a high, and the next day we trade above that high, and the next day we open above this candle's high, if it trades back down to this candle's high, this is an immediate rebalance. So this is something that I watch intraday. And if I watch, and this is why I also teach you to look at the last 3 days. That this is the secret why I teach it in my YouTube channel. I tell you to look at 3 days look back all the time. You think it's just the swing highs and swing lows because that's what I said there. But I also said that I left a lot of things out of YouTube.
This is the reason why I tell you to look at the last 3 days for immediate rebalances. So the